Hi, I'm JB. In this video, we're going to take a look at a strange phenomenon called the September effect, or the September sell-off. What the heck is that, you think? Well, it's a dip that seems to happen every year in September, and lately it's coming a little bit earlier in August. 1. What is the September effect? 2. Why does this seem to happen every September? 3. What can we as investors do to take advantage of this? And 4, I'm going to make a conclusion and some surprise findings maybe. It was a surprise to me actually, so maybe you'll think too. Let's get into it. One of the historic realities of the stock market is that it typically performs the poorest in September. And actually there's another month that's pretty close. We're going to take a look at that later. Studies have shown that on average, September is the worst month for the three leading indices. Institutional investors call this the September effect. Why does this seem to happen every September? Well, I think there are three main reasons, and they're kind of all related. Number 1, funds or investors, they rebalance, take profits when they end their year in September. And usually it's because large funds have their fiscal year ending in September. And this is where they're gonna take profits or end of summer, clean up, start over. Usually investors rebalance or change their portfolios at the end of summer to cash in their gains, or maybe to harvest some tax losses. And usually fund managers typically sell their losing positions before their year end. They want to get their bonus, right? Remember, I talked about the three indices, the Dow, the Nasdaq, and the S&P, and they're not completely correlated, but then again a little. Here we're looking at the Nasdaq 100 going from 2010 to 2020, and as you can see, February and March have the lowest rate of return, and August and September were following through, and actually September was the worst month of them all. And remember, this is an average through 10 years. When we then bundle the months together to get a better overview, you can see the point much more clearly. February, March, really not that good. August, September, really not that good. These 4 months rather, are the months where you actually could do some really good buys. So maybe you should focus on buying these months instead of buying all the other months. I'm going to show an example later on how this actually works. If we look at the S&P 500, going back from 2010 until now, the red arrows represent when there is a significant dip. The yellow is where it's okay, and the blue is when it wouldn't have helped. And as you can see, there are more red arrows than there are blue. And that proves the point that in 67% of times, these are the correct months to invest in. Here I've shown a graph of the S&P 500 from 2010 to 2021 and showing which months had the biggest declines. And as you can see, it looks like some investors pre-positioned actually because August is becoming more and more bad. And when we look at the Dow, we can see that it's almost the same. It's in May and it's in August, and not so much in December. So December is not as much hit on the Dow as it is on the S&P. So here we have to remember May and August. Looking at the Nasdaq, we see almost the same picture. It's May and it's in June a little, and again in August and December. So the Nasdaq kind of looks like a mix between the S&P 500 and the Dow. When we put them all together, we can see the best months to invest in is May, August, September, and December. And maybe a little bit in January. So I usually put December and January together in my investment bucket. So these are the 4 months I'm going for when I invest. Now I know, I hear you all shouting, "Hey, you can't time the market, that's not possible. The market can't be timed." That's true, and then sometimes not true. Everything in the stock market seems to move in cycles. If we analyze the data and see that maybe we could gain up to 7-8% extra over 10 years? That's some extra money I like to have. Let's look at an example. Here I've tried to compile the data for the S&P 500 from 2010 until today, and I compared the two normal ways of investing. So, if we assume that I only have my normal day job to contribute with, then I will use my monthly allowance from my day job and invest it. And we assume that I want to buy the S&P 500. So, 1. I could invest $1,000 every month, no matter what. Every month. Steady, slow, just like clockwork. No matter what. Ups or downs. $1,000 every month. Or I could save $1,000 per month and invest only in January, May, August, September would give the same result, so August, September, and December. And I would use $3,000 each month. Well, looking at the years, doing the investment method number 2, you can see that in 2010 you would have reached 1.3% more, in 11, 0.2, in 12, 1.7, 13, 1.0, 1.2 in 14, 1.0 in 15, 0.2 minus in 2016, 0.3 in 27, 0.2 18, 1.4 in 2019. Remember, we had a sell-off in September 19. And then 2020 minus 5.2%. Well, that's why I'm not counting 2020, because I would have invested differently then. And 2021 is not over yet, but it would have already given us a 1.4% more. So that's almost 8%, 7.6% if we discount the 2020 year. As 2020 with the pandemic was a really weird year, and I don't think any investor would stick to their normal investing strategy in a year like that. I know I went all in. I mean, I even borrowed money. I used leverage. I did everything just to get some great buys in there at March 2020. So we have to be prepared to move away from our normal strategy if something really exceptional turns up. The result would be that in 83% of the time, I would be ahead, and that's 10 out of 12 years. Granted, it's not a lot, but it's still money, extra money I would like to have. It's almost 8%. This year, in 2021, we're having a stupid euphoric market with daily beats and record highs. Globally, we're up around 15% since January, and this exuberance raises the fear level and extra vulnerabilities. So I'm guessing we're in for a really rough September. Also, the Fed is talking about tapering the money printing, and it usually has a negative feedback loop that when some sell, others get frightened and sell even more, and then go round and round and round. Well, I'm still bullish on the stock market, as conditions are still in favor for stocks. We have negative interest rates in the banks, we have bonds yielding below inflation, and the housing market is at an all-time high. Hey, where else would you put your hard-earned money? Well, thanks for watching this video all the way to the end. If I could trouble you hitting the like button and maybe even subscribe, I will do my best to make more relevant videos for us all to think about. Thanks. Remember, keep investing and invest safe.